Friends, just last week, on the night of the 12th of December local time, something happened that shook Wall Street to its core and sent ripples through wallets across the globe. Elon Musk publicly called out Bill Gates, accusing him of shorting Tesla, causing over $10 billion in catastrophic losses. If you thought this was just a petty spat between two tech billionaires, think again. The media played it down, investors laughed it off, and analysts acted like it was no big deal on television. But I'm here to tell you, the stakes are much higher. This isn't entertainment news. This is a life or death moment for your assets. Miss the lesson, and you lose money. Hesitate even slightly, and the market will take it from you. Here's the thing everyone's missing. Bill Gates wasn't just betting against Tesla. He was betting on the collapse of the new energy narrative and the revival of the old world. And Musk, he wasn't just hitting back at a rival. He was declaring war on the entire Wall Street short-selling alliance. Make no mistake, this isn't a fight between two men. It's a massive reshuffling of wealth and a reconstruction of industrial narratives. Where will the money flow? Who will get rich? Who will get cut to the bone? Today, we're going to tear it all apart to truly understand what Gates was betting on and why he ended up losing so badly. We need to pierce through the surface and get one thing crystal clear: the short selling mechanism. Don't let the term scare you. It's simple. You can think of short selling like this. Someone bets you'll fail. They borrow your stock, sell it, and hope to buy it back cheaper later, pocketing the difference. Picture this. Your neighbor comes over and says, "Hey, can I borrow 10 of your cars? I'll sell them now and bet that in a few months demand for electric cars will crash. I'll buy them back cheap and return them to you. Profit in the meantime is mine." Sounds a little shady, right? That's short selling. It's a wind against the sales game, betting on someone else's failure, betting against progress, betting that innovation flops. And Gates shorting Tesla. This wasn't an impulse move. He started laying the groundwork back in 2020. That was the year Tesla's valuation skyrocketed. The world was obsessed with the new energy bubble. Everyone was calling Musk Iron Man while dumping money into EVs. But Gates, he wasn't looking at the hype. He was looking at the numbers. Does the EV business model actually generate cash flow? Can it cover costs? Can it survive without subsidies? This isn't personal. It's cold, hard capital logic. I went through every short-selling report, institutional holding change, and hundreds of pages of 13F filings since 2018. The conclusion is clear. Part of Wall Street never wanted new energy to become the new king. They wanted it to be a luxury toy. They wanted oil services to keep profiting, natural gas pipelines to keep rolling, and the traditional auto supply chain to keep controlling margins. Gates was betting on that old world inertia. So why did a decades-old short-selling setup suddenly become deadly today? Why did it fail for Gates? What triggered the chain reaction? Here's the truth. This isn't Gates losing money. It's the new energy narrative being revalued. It's not Musk getting angry. It's Wall Street's old order losing its moat. Why did Gates suffer such brutal losses? Simple. He underestimated the industrial turning point, overestimated regulatory inertia, and misread the liquidity direction. But what does this have to do with me, you might ask? I invest in TSMC or Nvidia. I don't touch new energy. Wrong. Money doesn't just stay at the top of an industry. It flows across the entire risk spectrum. When a narrative is repriced, the whole market reshuffles. Tech valuations, cash flow discounting, interest rate baselines, AI capital allocation, market style preference. All of it changes. This affects your wallet. If you're not keeping up, your capital becomes sunk costs and quietly gets harvested. And there's more. The most cunning move is something almost nobody noticed. Why did Musk choose this exact moment to publicly highlight Gates' losses? You think Musk just blew his top, that he suddenly wanted revenge? Think again. Behind this is Musk's triple play: policy windows, interest rate cycles, and narrative control. Picture this. When interest rates shift, when the Fed releases liquidity, and when the market can't find the next certain growth, whoever controls the story absorbs the money. What does that mean for your cash? Simple. Funds exit old value pits and flow toward new tech narratives with high certainty. You might think Gates lost $10 billion because of a tech misjudgment. Wrong. He used the right tool at the wrong macro cycle. Next we must ask, Was Gates' loss an individual failure or a death sentence for the whole short-selling alliance? If shorting is weakening, who will get rich? Who will explode? And where will the money flow? Now, let's lay the cards on the table. Gates didn't just lose money, he lost the relevance of old financial tools. Short selling, in the face of macro liquidity, is losing power. Why? Three key factors. Interest rates are turning. Tech manufacturing is genuinely profitable. Breakthroughs in storage, charging, and supply chain efficiency have shattered old world barriers. In Gates's short logic, new energy doesn't make money, lacks cash flow, has no cost advantage. But reality is the opposite. Costs are falling, scale is expanding, government support is shifting towards supply chain control. The core fact: new energy is entering a self-sustaining business model phase. What does that mean for your money? When an industry shifts from subsidy-driven to profit-driven, it can absorb long-term capital. Once it absorbs capital, market style turns growth-oriented. The market starts rewarding the future, not the past. So it's not about giving Musk face. It's about rewarding a priceable future. Let's trace the money flow. Money flows out of high-interest cash arbitrage, traditional energy, and cyclical industrials. It moves through ETF structured products, hedge fund growth positions, and sovereign fund rebalancing. It lands in new energy, AI computing, and tech manufacturing with real cash flow. Let's be blunt. Gates didn't lose to Musk. He lost to rate changes plus scale, cost curve plus ETFs, structured capital. Once the matrix forms, shorting is nearly impossible. But short selling has value. It's the market's brake to prevent bubbles, right? Sure, but the market structure has changed. Historically, shorting captured fundamental deterioration. Now, it's mostly betting on policy missteps, risk, policy shifts, and you blow up. Why did Gates blow up this time? He misread policy. He assumed. Policy is anti-inflationary rates. Stay high new energy, can't survive without subsidies reality. Policy is pivoting toward industrial security, supply chain independence, energy sovereignty. Betting against new energy now is gambling against geopolitics. Gates also underestimated the emotional amplification of growth narratives. Imagine dominoes. Storage efficiency falls into place. Battery margins improve, government orders pour in equity, financing powers. The supply chain suddenly, the market realizes the company doesn't need subsidies. It has a financing engine driving the entire supply chain. That's the key surface winners. Tesla, BYD, California, they look good, but their shareholders aren't all laughing. Rising revenue without profit. Cash flow pressure, price competition, supply chain bargaining shifts. Who's quietly profiting? Old economy, cash flow machines, copper mines, energy equipment, wind materials, storage inverters, cabling suppliers. Why? Fixed supply and slow capacity expansion create hidden pricing power financially. Derivatives market makers win big. They control pricing, volatility, and hedging, collecting fees and hedging costs from both sides. The shocking truth: Gates didn't lose to Musk. He lost to the volatility. Driven seller, structure market machine. Worst hit, not Gates, not retail investors. It's the new energy car makers surrounded by good news, but squeezed out by institutional profit capture. The game has shifted from growing the pie to redistributing the pie. Now, why did Musk publicly shame Gates? It's not for revenge, it's narrative repricing. Money follows the story, twists the story, and money reshuffles. And when money reshuffles, your wealth faces choices. Finally, risks and actions. Market revaluation is faster than real profitability. Money flows in before profits catch up. Tighten liquidity and valuations pop. Supply chain concentration plus cost tightening creates fragile advantage. Scale slows, cost spike, profits turn negative. Policy backlash is real. Subsidies may vanish, taxes may rise. Trade barriers may hit. Business models can instantly get shackled. Summary: Gates shorting Musk equals old world financial tools, losing to new world liquidity. Gates loss equals narrative control and timing window, not just money. New energy wins equals cash flow suppliers and supply chain efficiency winners, not car makers shouting slogans. Biggest takeaway equals capital realignment, risk appetite reignited, growth value pendulum swings, opportunity window very short. Early movers capture trend dividends. Latecomers buy at the peak. The market chooses for you if you don't act. That's why I compiled an exclusive internal list, core execution paths, and potential watch list in the new energy narrative reconstruction. Real strategies, not slogans. 3 key directions: supply chain cash, flow machines, cost, advantaged manufacturing, policy, secure energy infrastructure, full logic, drivers, triggers, validation data, and cycle realization included. All you need to do, click the pinned link in the comments, send the code Wealth Security, and claim it. For the first 1,000 movers only. Miss today, and you might regret it. Friends, my job is to clear the fog, tell the story straight, and protect your wallet. So gate shorting and losing, future antidote or poison. Market health reset or bubble rehearsal. Drop your take in the comments. Speak up. Think, argue, and capture your own wealth evolution.